My name's John Newman. I work for a fund called Capital Partners, pretty generic term. We are a Norwalk, Connecticut fund, been around since 1982, hence the generic term. It was original back in 1982, I suppose. We started as an independent sponsor, so for our first 20 years we were an independent sponsor. We're currently investing out of our third fund, which has been around for 15, 20 years. As we've been around for 15, 20 years as a fund. As Gerald mentioned, we're a little bit different insofar as that we're, well, I'll say how we're generic. We're 5 to 15 million of EBITDA. We're generalist investors, and so and our name. So we're pretty generic in that sense. Where we're different is we under-lever our company. So we're putting maximum 2.5 to 2 3/4 leverage, and it's always bank debt. So we don't do any mezz or junior debt.
And why is that? What is your belief?
I'll get to that. How about that? So that's on one side. And then on the equity side, we just do common equity, and we pay a yield on the equity. So it's not preferred. It's not a contractual obligation, or it doesn't PIK if we don't pay it. But it's just, at the end of the quarter, the team gets together with the board and says, okay, what did this quarter look like? What are the next few quarters likely to look like? We're going to pay out a yield, and we target an 8 to 10% yield. So you ask, why do we underlever? Part of it is to allow us to pay the yield. So our banks, we've negotiated covenants such that as long as fixed charge coverage is 1 times or greater, we can effectively pay out as much cash as we want. And then the other is we are a little bit more on the conservative side for leverage. And so that's just sort of in our DNA. So we are not, I wouldn't call us growth investors per se. So we're not, our companies aren't plowing every dollar of cash back into the business to juice growth. We're more focused on cash flow generation and sort of growth over the longer term. In our experience, most owners have operated their business with no debt. Maybe they have a line with their local bank, but in general don't like leverage. Most owners love taking cash out of their business, either through super high salaries or perks, or many family members being in the business and taking salary. And I should also mention we only own pass-through entities. And most founder owners like the benefits of owning a business through a pass-through entity. And most private equity firms will put a C Corp blocker on top of the pass-through entity when they buy a business. So we're trying to be attractive to founder owners who have traditionally not used debt and don't like debt, have traditionally taken out cash and like taking out cash, and like owning businesses in pass-through entities. Most founder owners also, they've had all their money in their business, and part of the reason is that they view their business as almost a non-risk investment because they know it so well. So this allows them to take some money out of the business, but continue to be invested in their business and continue to take cash out.
I'm curious, do you ever buy 100%, or you always have that rollover from the owner?
As with most private equity firm, in my experience, limited experience, most private equity firms like some measure of rollover. When there is an owner who wants to sell 100%, to be perfectly honest, that's a pretty big negative for us.
Yeah. And what kind of a risk do you see with owner departing completely?
Well, if he wants to sell he or she wants to sell 100%, that requires a greater level of diligence because you're having to turn over every single stone. Whereas if he or she is willing to roll, particularly a good chunk in, you feel like they have skin in the game. And then the other part is if they're a CEO and they're looking to leave, you've got to find a new management, senior management team, which there's always risk in that, particularly at the beginning of an investment.
Customer relationships also seem to be attached to the owner, right?
Oftentimes, yeah.
All right, well, thank you. And I know your firm has attended before. Is it your first time?
No, this is my third time.
Third time, okay. Yeah. Well, thank you for coming back. All right, Andy?
Afternoon, everyone. My name is Andy Baker. I'm the founder and managing director of Tyrian Capital, an independent sponsor firm based here in Chicago. I've been involved in private equity and family investment offices for about 15 years. And that's where I started my career in private equity. I was working for a very large family office here in Chicago. I launched my firm a couple of years ago. I focus on, although I'm a generalist, I spend probably half my time in manufacturing businesses. So those of you that have domain experience in that more broadly, I'd be very interested to talk to you. And I focus on companies that are 2 to 10 million in EBITDA, where EBITDA margins are 10% or higher. What does an independent sponsor mean? It means that I get to tailor the capital providers for each of the deals that I do. And that means that if there is a strategic angle that I can extract, I can do that. It also gives me a great deal of flexibility to get the right capital structure for whatever deal I'm looking at. I mentioned that I started my career in private equity in family investment offices. That's the primary source of the capital that I use to do deals. That also has benefits, which I'm more happy to get into, but it makes Tyrian Capital a little different than some of the other firms you'll meet today.
How different, or how does it make?
Partly because we, as a smaller firm, I tend to get, I think, a little deeper into the companies. So I have a portfolio company up in Wisconsin. I think I'm about as close as being as you can get to being in an operating role without being in one. I think that's the best way to get to know the company. Every situation is different, so there's always going to be partnerships with executives and myself, but I take a very active role in running my businesses, and so that's a little different perhaps than other folks.
All right. Well, thank you. And you've attended before.
I have been here before. Yes. Yeah.
All right. Paul, please introduce
Sure.
yourself.
Good afternoon, everybody. My name is Paul Coloma, and I work at a private capital fund called Chatham Capital. We're based out of Atlanta. We've been in business since 2001 and deployed over $1.2 billion
I'm sorry. Can you
over
pass this
180 transactions. These 180 transactions have been done in a smaller number of companies. So it's about 85 companies that we've provided capital to. So common theme is we like to provide capital for growth. We like to provide capital. We like to do the initial underwriting, and then the second underwriting is a lot easier when you're buying something else. One thing that we do, a little different, I guess, than a lot of the debt providers, is we focus on sponsor deals, independent sponsor deals, and also management-backed deals.
Can you, just for clarity, sponsor deals means there is a financial buyer.
Yeah, that's right. A financial buyer. Those are the easier deals to underwrite on our part because we'll just take the sponsor's investment memo and we'll just do a little bit more diligence. But at the end of the day, we are basing our decision to underwrite on the track record of the sponsor, on their diligence, and then also because there's a good amount of equity above us in the capital stack, we feel pretty good about going in as well. Then you go independent sponsor as well, where you're tailoring the capital structure, to say, Andy. There are instances where the independent sponsor can structure a deal where equity is pretty close to zero, and we are okay with that as well.
Can you describe what kind of deal that might be?
Yeah, sure. Actually, we're doing a deal right now with an independent sponsor. I'll leave it on a no-name basis, but it's a family-owned business. They are looking at cashing out. The family has a very good relationship with the independent sponsor. Independent sponsor got it basically on an exclusive basis without going through a sell-side process, where the purchase consideration is 3 times EBITDA.
So that's the key, right?
Yeah, that's the key, exactly. So they negotiated a really good purchase multiple, and that's the value they're adding. And the business is as stable as it gets. Us debt providers love stability and recurring revenue, so we're able to provide them 3 times. So that's something that's a little different as well from from our firm than others. If you go to a bank, you'll probably hear that you need at least a minimum X% of equity, of which a smaller amount has to be true cash equity going in. But we're okay with going with zero equity, in exchange for some warrants or some minority ownership as well that will vest at some point in the future.
And in your deal, I'm sorry,
Sure.
who is the majority shareholder?
Oh, the
This
majority
deal?
shareholder is going to be the independent sponsor.
Mhm.
They're putting in like $60,000 to get it.
So that's it's very lucrative, right?
Yeah,
as an
very.
investor, as
Absolutely,
an
they
equity investor.
get
extremely-
almost 100% of the upside.
But two parameters I heard you say. One, the purchase price is very low multiple.
Very low, very
And second,
attractive.
the company is very stable, right? Low risk.
That's right. Yeah. I mean, you look at stability of revenue, right? I mean, if you look back 10 years through even better if you have information through the last recession, and the revenues have been pretty consistent. I mean, maybe trending upwards alongside with GDP. That's a pretty stable business. Since we don't, as debt lenders, we don't get much of the upside. We typically don't care if it grows 20% a year. That's not what a true private equity provider is ever going to look at. But we do. And the other one is stability of margins. So that means, are they able to pass through costs, or are they able to increase prices, or is it some arrangement like a tolling arrangement where the margin is pretty much set all the time and you don't have to worry about your margins ever getting eroded? Is it in an industry that is very protected from competition? What are your moats, your barriers to entry? The more the better, right? So that's what we like.
In most cases, in order to produce a return, you have to change something in the company, right? And on the one hand, and the other hand, you don't want to harm the company. It's, usually companies that you invest are quite small. So, and the executive comes in as new CEO. So how should they expect to work with you to make the change, not harm the company, and maintain, the kind of relationship, the transparent relationship that you supposedly would want to have. So maybe you have some examples where there was a change with an executive. How did it happen? Who makes decisions to hire, for example, or who makes a strategic decision to invest or do M&A? Is it primarily people in your firm? Is it the executive? Is it the board? So maybe we'll start with you, John, or whoever wants to
Go
start.
ahead. I think all those things are important, but if you're talking about the initial transition, it's far more important that the executive builds a relationship with the employees and the team that is already in the company. That's one of the key risk areas in any deal, particularly if this is the first time that there's been institutional capital, for example, and it is transitioning out of family ownership, which is almost always the case in the kind of deals that I'm looking at.
How to do that?
It sounds a bit trite, but it's all about communication. It's all about. I'll give you an example of a company that I acquired about a year ago. It's a 70-year-old family business. The founder passed away 20 years ago, left the business to his 3 children. His 3 children were never active in the business, but the guy who built the business had been president for 45 years. Almost everything that happened within those 4 walls happened because that president had made it so, right? So the most important thing that we could do when we closed this deal, I say we, I mean me and the executive that I worked with, was not upset the apple cart with respect to that relationship. And I don't think there's a blueprint for doing that. Every situation is different. But you have to win over the confidence of the folks that are ultimately going to build your business for you, which, and this is a manufacturing company, that goes all the way down to the machinists and everybody else. If you lose that, or if there becomes some sort of issue that isn't addressed, it becomes very difficult to recover. And no amount of sort of CEO replacement or front office replacement of resources is necessarily going to fix that problem. So I think that's a really often actually overlooked part of making that transition stick. To answer the other aspect of your question, who decides what? Again, it should be partnership. You as an executive should feel, assuming that you're taking the CEO role in this company, that you have a partner with your backers, your private equity firm. And clearly, you expect the private equity firm to bring something to the table. They expect you to deliver whatever the strategy is that you agree upon. But you shouldn't be looking to them to come up with the ideas. You shouldn't be looking to them to be running the company and you're working for them. It should be a partnership. And so all of those decisions should be mapped out ahead of time as to who is going to do what and how it's going to work. And it comes back to the same point about communication. I think that's the most important thing that you can do, is to develop this relationship and execute the plan that you guys come up with.
Thank you. Paul, in your situations, your firm is not actively involved. Is that
Well,
right
we
assumption?
do get,
In the business?
not in the sense that we are managing what the executives are doing on a day-to-day basis, where we do actively monitor our investments on a monthly basis, and
What
we
does
do
it
that
mean?
by our covenants.
You look at financial statements?
Yeah, that's right. And then we typically will want to talk to our CFO of our portfolio companies at least once every month, figuring out what's going on, how are the numbers different than what they had expected, either good or bad. And if they're trending negatively, and it's going to be something that will continue, we need to know it sooner rather than later, because that could spell some potential problems down the line. Where we interact with private equity sponsors and with management is at the beginning of the process. We're very actively involved in setting the covenants, setting what is an appropriate covenant package that may not reflect the sponsor's upside expectations, but maybe just enough, will provide enough growth that you don't worry about. If you don't hit that growth, you're going to bust out of your covenant.
Can you maybe explain a little bit more? What does it have to do with? Does it have to do with the cash available to spend?
Yeah,
on growth, or?
sure. I mean, and we have different metrics that we look at as lenders, right? So we look at debt to EBITDA. So we don't want to be in a position where, debt to EBITDA is greater than X, right? So if we provide you 3 times leverage, maybe it's 4 times, right? So that means your debt's growing, but we're the ones providing the debt, so it's probably EBITDA is going south. So if that's the issue, we want to make sure that we're at the table figuring out what's going on, as we're carrying most of the risk at that point. Fixed charge coverage ratio as well, as you mentioned, it's just a measure of liquidity. Right, so at the numerator you have EBITDA minus your capital expenditures minus your taxes, and then on the denominator you have your debt service coverage, right? So that's your interest and your principal. So it basically means, are you generating enough cash flow to pay us back? And if you're not, then that's a problem. And the other one is, it depends, right? It depends on what deal we do. We may have minimum EBITDA deals if it's a stable business. We're not worried about EBITDA jumping up and down. We may have a minimum interest coverage ratio or minimum liquidity as well, just to make sure you have enough cash in your bank to pay for your, for all your expenses, just to operate your business.
Okay, thank you. Any questions so far? Then I'd like to talk about alignment of interests. John, you already talked about that, having sort of aligned with the owner's interest to maintain the lifestyle, right, with having that cash flow from the business. What would you typically do with if you have incoming executive, CEO or another type of executive, how do you align their interests with yours? It's not just salary, right, that they compensated by?
Right.
Can you talk more about that?
So most private equity firms, when they buy a business, they reserve what's generically called an option pool that is somewhere in the high single digits to low double digits of equity. So in effect, the private equity firm is putting in 100% of the equity, or whatever equity sources are at the time of close, are putting in 100% of the equity, but they're really buying, call it 90 to 92% of the company. And this option pool is so that either existing management members or, in all likelihood, new members that will be added to the team over the course of the investment are going to have some opportunity to participate in the upside. And normally that option pool participates after some annual yield is achieved at the time of exit. So call it a 8, 10, 12% annual yield achieved at the time of exit.
So that
If
would be
that's-
preferred?
Pardon
You
me?
mean that would be a preferred return you have to achieve first?
That would be the return that the funded equity would have to achieve before the option pool would be, quote unquote, in the money. So,
So why is it important to have this kind of compensation in addition to salary and bonus? Why do you do that? Skinny,
I mean,
yeah, aligning this, right?
We're all sort of motivated by upside, and the option pool can be a very good mode of encouraging people to be all sort of rowing in the same direction and long-term focused rather than just salary focused. And also, frankly, it's a little bit of the golden handcuffs, as they say, as well. So if you're work for a private equity firm, a private equity owned company for 3 years, and you think it's going to be sold in the next 2 years, you're unlikely to leave.
Very good point. And can you talk a little bit more about the bonus? How would typical KPIs do you attach your bonuses? Is just say EBITDA, or there more to it?
Well, it certainly depends on what your title is. I mean, if you're a CFO, you're likely to have different KPIs than you are if you're going to be a CMO or a COO. So obviously, with CFO, it might be, look, we need to implement this ERP system. You need to be involved in that. And I'm not sure if it's going to be hard and fast KPIs, but you might say, okay, how's the implementation gone over this first year? If it's gone well, you get more of your bonus. If you're a COO, they're going to be more operationally metric driven. CMO, again, depends on what type of a company it is, but let's say it's a DTC company, how well are you in, what are the costs to acquire a new customer, et cetera. I'm a little bit over my skis on that one, but different metrics depending on the different responsibilities.
So you're aligning metrics with their responsibility. If one person is supposed to drive the sales or
Gonna
new
have
customer acquisition, that's how
different
you
metrics.
align it. If
Correct.
it's COO are focused on improving operation, that's how you align it.
Yeah.
Okay. We have some questions, please.
So John, earlier you said that greater the sale of the equity by the owner, greater is the due diligence. Is that right?
What I was more saying is, if it's 100% sale, you and the guy is moving down to Florida.
Yeah.
The level of diligence required to get comfortable with that is likely greater than if there is some equity. I'm not necessarily saying that if he rolls 10%, you have one level of diligence, and if he rolls 50, you have a different. I'm more just making the differentiation between 100 and everything else.
Okay. But when you said greater diligence, is it greater in terms of degree or kind? Is it quantity?
What is the difference?
Is it quantity of diligence or qualitative?
Do you do the same diligence, more of it, or you do additional, something of additional sort that you wouldn't do?
You do more diligence on the same items, I suppose. Yeah.
More granularity.
Yeah, more granularity, yes.
All right. Any questions? We have
Does your
Please.
typical board makeup look like it? Industry experts? How do you find your board? How do you place your board?
So I got it. I'll just go first and pass it down. So our board is usually comprised of the CEO, who sometimes was the seller. If he wasn't the seller, oftentimes it's then the seller who's maintained some level of ownership. It's two capital partners representatives, probably the lead on the deal, and then another MD or managing partner, but not necessarily the lead. And then there'll be one independent board member who is chosen in consultation with the four previously mentioned persons. That individual may have helped in diligence, or may not have, and is chosen after we acquire the company.
Somebody you meet at Blackmore next or something.
Always somebody we meet.
Oh, thank you for the plug-in. Any other questions?
Well,
I'm
you
sorry.
want
Yeah, very similar. We have folks from my firm. We'll have folks from our capital partners, and we do think it's important that there is an independent, and depending on the situation, that there is also outside industry expertise as well. I think one of the things that makes people successful is understanding, as much as understanding what they know, is what they don't know. And it's always helpful to have some domain expertise as you navigate whatever challenges you're dealing with at the company and the board level. So that's a typical makeup for us.
And for us as debt lenders, we typically just like board observation rights. So we don't require a seat at the. We require a seat at the table. We don't necessarily require a vote. That's the only difference.
And I'm going to add some color. There are different types of, because I hear so much of what our talent group does, there are board members who are called door openers. They're industry experts, and they know everyone in the industry, and they knock on the door and they say, this is the CEO. I'm working with Andy Miller. He's a private equity owned company. I'd love to introduce you. So there's that type of thing, especially where it's a sales-oriented, high-growth type situation. Some of the other capital buddies talked about, there's chairman level. A chairman typically is more a person working part-time, but is much more of a mentoring, and has maybe worked in both large companies, small companies. I see it a lot in healthcare, and they're really working with the companies on scaling appropriately to the culture, right? If you overstimulate a company with too many people, process, technologies, you kill off the company. So there's different types of chairmen. So there's you got to find out. There's nuances. Any color on that, Yelena?
From our perspective, we always look for industry experts who can sit on the board, independent. I'm sorry, you have a question?
Well, so what is the role of the board then? Is it a governing board?
Oh,
Is it an advisory board? I mean, do they have decision rights, especially when PE's involved? I mean, they're the ones who are making the decisions, right, at the end of the day.
Yes, excellent questions. Can you please elaborate what is the difference between areas of responsibility among the CEO, the board, and the investor, and probably in different situations?
I think in particular the type of companies I'm investing in, there's a mix. There are clearly strict governance guidelines that the board will follow. So there will be, in terms of corporate actions and things like that. Clearly, the board has the role there, but by adding in this independent/industry expert, it really becomes more an advisory. Ultimately, what I want to see is that the CEO has support in executing the strategy. I don't mean that he or she is pushing execution to the board, but that there is a network of support behind the CEO in order to hit. It can be lonely, right? It's not an easy thing to do, and so you want to make sure that they have all the resources at their disposal to be able to do what you all the shareholders want to achieve with that business, and the board is a big part of that.
Andy, what about setting the strategy? Who does that? Who is expected to do that?
It needs to be collaborative. I mean, there's been a lot of discussion today about how do you sort of convince an owner who wants his son to run the business to sell the private. There are some opportunities that just won't work. You have to be in the owners of the business have to be in a position where they want to do a transaction and that they understand the value of what that is. And it's obviously important for either an executive or private equity firm to explain what that value creation is about and why it makes sense. But it means that you should have a collaborative relationship. So I'm certainly not smart enough to come in and tell somebody how to run their company and execute strategy. But what I can tell them is, here's my experience and here's what I've done in the past and here's how it worked when I've been in similar situations. So I don't think that folks on this side of the table would pretend that they're experts, but what I think they are good at is finding people who are experts and ensuring that experience is shared in order to get to a strategy that everyone can agree upon and then execute.